I think in a 3 to 5 year period, we're going to see probably $90 to $100 silver and probably, I don't know, $5,000 to $7,000 gold. We may see a bit more of a pullback. I think between now and the end of the year, I think we'll still be below 5,000.
Gold has not changed. It's the value in terms of the government's debt-based money that has changed and been devalued. And this is why it is so critically important for you to become your own central bank. And even if you make the choice to hold intangible wealth, you need to do whatever you're comfortable doing. Proper diversification requires you to hold a certain level of gold so that if those other things go away, you're covered. It doesn't matter.
Financial experts Rich Checkan and Lynette Zang share powerful insights into the future of gold and silver, forecasting a potential surge in prices over the next few years. They believe that silver could climb toward $90 to $100 an ounce, while gold could reach between $5,000 and $7,000. Despite the possibility of short-term pullbacks, the long-term outlook remains bullish. The message is clear. The true value of gold hasn't changed. It's the purchasing power of government-backed currencies that continues to erode. As global debt grows and fiat currencies lose strength, holding tangible assets like gold becomes essential for financial protection. Investors are encouraged to think like their own central bank, ensuring proper diversification that includes physical gold and silver. Whether you choose to hold metals directly or through trusted instruments, maintaining real wealth outside the financial system is key. This perspective highlights why precious metals continue to play a vital role in preserving wealth amid ongoing currency devaluation and global uncertainty. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on gold, silver, and the markets.
A rise in gold and silver prices are an indication of a failing currency and a looming crisis. I hope everybody watching this can see that we are already in crisis. That's one thing. Another thing is that the gold and silver are used, especially inside of the system. So this is just paper gold and silver. They can create as much of that at will as they want to. And those contracts, spot gold, spot silver, that's what you're really talking about here. Those are simply paper contracts. And remember, it was back in January when, especially the Bank of England, but there was a lot of physical gold and silver that was shipped over here to the US and then delivered out. And we talked about the backwardation. In other words, current prices being higher than future prices because entities do not want to risk not getting their gold and silver. Because the futures contract, the assumption is there's a specified date at a specified price that you can, anyway, in theory, take possession of the physical metal. But the US was not really about taking possession of the physical metals. It's just trading those paper contracts or those digital contracts back and forth. So if an area over here is imploding, well, they get what's called margin calls. And if they've done this using those contracts as collateral, and they have to liquidate those paper or those digital contracts in gold and silver to meet those margin calls. But the physical world does not work like that. In the physical world, it is simply supply and demand. That's why I show you the charts on the PCGS 3000 and the ultra rarities, because that's the only place where I can really show you what's happening in the physical demand world. If you're looking at what Wall Street puts out, the spot gold contracts, the spot silver contract. So when they say, when you're listening to Bloomberg or CNBC, or even when they put across the ticker gold, put spot in your mind. Put spot in front of that so that you are seeing that that's a contract price and has nothing or not much, because it does have a little bit to do, but not much to do in the purely physical world. And there's bullion that will reflect what happens in those spot contracts more. The collectible coins do not. That is purely a supply and demand market. And look, I think diversity in everything makes a whole lot of sense.
I do not see any other challenger to the US dollar coming on the market anytime soon
Right.
to supplant it as the world's reserve currency. I think a lot of folks would like to, but there's nothing, not China, not the BRICS, et cetera, that are anywhere near the point where they need to be to replace the dollar as the world's reserve, which means we're going to continue to have a weak currency, the US dollar, with a potential to weaken further as our reserve, and people will look for the most viable alternative available. That is gold. That's what they've been doing for 4 years, Ivan. It's not going to change. It's absolutely going to benefit the gold price. This is absolutely a healthy pullback. Put it in perspective. We were going up $100 a week in the price of gold. Okay,
Right.
for a sustained period of time, and then we had a 10% correction. All right,
Yeah.
big deal. Big
Yeah.
deal.
It's
I
nothing.
mean, yeah, it needed to happen. It's healthy. We may actually see a little bit more of a pullback. That wouldn't scare me either.
Market analyst Rich Checkan and Lynette Zang shed light on the growing disconnect between paper and physical gold and silver markets, explaining how rising precious metal prices signal deeper systemic problems. When gold and silver prices rise sharply, it often reflects a weakening currency and an approaching financial crisis, a situation that, according to many experts, is already unfolding. Most of what's seen on financial tickers and platforms like Bloomberg or CNBC refers to spot gold and silver, paper or digital contracts that can be created in unlimited quantities. These contracts don't necessarily reflect the true physical market, where supply and demand determine real value. In contrast, physical bullion and collectible coins operate in a market driven purely by scarcity and investor demand. Recent trends show significant movement of physical metals with backwardation, current prices higher than future prices, signaling that major entities want immediate delivery of gold and silver rather than risk shortages later. While the US dollar remains the world's reserve currency, it continues to weaken. No global alternative has yet emerged to replace it, but that only strengthens gold's position as the ultimate store of value. Temporary pullbacks in price are natural and healthy, part of a long-term upward trend fueled by demand for real assets over paper promises. Let's get into the interview.
QT is quantitative tightening, and they want you to believe, they being the central banks, that they've been tightening because they've been running off their balance sheet. In other words, all of that, the government bonds that the central bank bought, the Fed bought, they've just been allowing them to mature and not reinvesting that principal or those dividends. So the liquidity, QT is supposed to be pulling the liquidity out of the system, but it really hasn't been. And I've shown you in the past, and you can go to the FRED, F-R-E-D, the Federal Reserve Education Department, and you can put in there the liquidity conditions or the credit conditions, and you're going to see that there hasn't been any QT. Now, where the QT comes in is in the crisis like we're witnessing today. That liquidity, because of those defaults, have been sucked out of the system, which has forced those non-banks and also the banks. This is not just a non-bank issue, because remember, those non-banks, that private credit, that private equity has been going and getting money from the banks. And that's the problem, is the contagion.
Whenever the stock market has a big pullback, right? All the mainstream pundits come out and they're all on the same script. They read from the same narrative. They basically says, you know what, you need to stay invested long term. You know, you got to be in it to win it. No panics, keep calm, carry on, and all that. And then gold, after its run, the first things out of everybody's mouth was, that's it, that's the end. We told you not to buy into this. It's crazy. It's a barbarous relic. You should get out now. We continue to see central bank buying, right? So they're increasing their reserves of gold. We may not hit the fourth straight year of 1,000 metric tons in central bank buying this year, but also keep in mind, gold's a lot more expensive than it was when they started this 2-3 years ago, right?
Right.
So gold is double the price, and I still think we're going to scare 1,000 metric tons this year. So yeah, there's got to be a reason driving foreign countries to increase their reserve assets in gold. And for me, it's the number one and foremost is the dysfunction in the U.S., the mismanagement of the U.S. dollar. Now, there's talk over the weekend that we're one step closer to potentially ending the government shutdown in the U.S., but it's the longest in history. We're in our third or fourth year of deficit production now, and the first year or two wiped out the 11 years of surplus production. So we're needing more and more silver. They're being used in solar panels and other functions, batteries, et cetera. Silver needs are not going away. Investors are now starting to buy up silver as well. It can only help. Putting it on a critical metals list, I don't think changes the scenario one iota. In fact, it probably just adds a little, jet fuel to it.
Recent market turbulence has revealed the cracks in the idea of true quantitative tightening. Central banks claim they're reducing liquidity by letting assets mature off their balance sheets. But real credit conditions show a different story. Despite official narratives, liquidity remains in flux until crises hit. When defaults rise, liquidity suddenly vanishes, pressuring both banks and private lenders, spreading contagion throughout the system. During these moments, gold shines as a refuge. While mainstream analysts urge investors to stay calm and dismiss gold's rise as temporary, central banks continue to buy at record levels. Even with gold prices doubling in recent years, global demand remains strong, driven by distrust in U.S. fiscal policy and a weakening dollar. Meanwhile, silver's role is expanding beyond investment demand. Industrial needs like solar panels and batteries are adding pressure to already tight supplies. Its classification as a critical metal only amplifies that momentum. These conditions point to a long-term shift away from paper assets toward tangible value. Precious metals aren't just investments. They're protection against currency decay and systemic risk. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on gold, silver, and the markets.